Hello, and welcome to today's episode of Container Bytes. I am Julia Frowine here, as always, with our residential freight expert, Judah Levine, to kick off another bite-sized session of the latest in freight. Judah, how are you doing today?
Good. How are you?
Yeah, doing all right.
All right.
All right, let's get to it. So it looks like the US and Iran are getting closer to the end of the war, which could reopen the Strait of Hormuz. As we've seen, the biggest impact for the container market has been the price of bunker fuel. So if it reopens, how quickly do you think we can expect pressure on freight rates to ease?
So certainly it's a big question mark how close we are to a negotiated end to the war. It seems negotiations are underway and continuing to take place, but it's really unclear when this is going to happen. That being said, you do see vessels who are kind of been stuck in the Persian Gulf moving towards the Strait of Hormuz in anticipation. Now, we've seen this before when the ceasefire initially took place back in April, that you saw vessels, moving to get ready to leave, and then it became clear that the strait really wasn't opening, and they went back. So it's not to say that it's here now, but it is kind of a sign of optimism by some of these ships that have been stuck there this whole time. Yeah, as you said, the price of the fuel has been the big impact for the container market. And when the strait reopens, we'll certainly see price of oil decrease from where it is now. But a lot of experts say it's really going to take time until prices normalize. So price of oil will stay elevated compared to where it was before the war for probably months, because it's going to take time for production to ramp back up. It's going to take time for oil to get to where it needs to go. And also there's been infrastructure damage during the war, which will reduce the output for a while. And this is going to be even more true for refined oil products like bunker fuel and also jet fuel. That is just, first the crude has to make its way into the market, and then it needs to be refined. So it could take even longer. Some experts say it would take into next year until we see prices kind of go back to that pre-war baseline, but they'll certainly come down from where they are, now, and they've already come down from some of the peaks we saw earlier in the war period.
So in the meantime, it looks like peak season is starting for the east-west lanes. What has that meant for container rates?
Yeah, so for Asia to Europe, we're starting with Asia to North Europe. GRIs in May kind of gradually pushed rates up about $300 per FEU. Now they're about $2,900 per container for Asia and North Europe. So that's back to kind of the wartime high that we saw at the end of March. And it's almost at the level we saw in the lead up to Lunar New Year. So we're certainly seeing rates kind of elevated compared to their baseline. Asia Mediterranean rates spiked 20% last week. They're up to 4,400, which is higher than they've been since the start of the war. So there's certainly signs that demand is also playing a role right now, since we've continued to have high fuel costs, but rates haven't kind of gradually continued to go up on these lanes. So one reason for peak season starting, and this is a little earlier than we would have seen during more typical times, is that shippers on these lanes are still accounting for longer lead times because of the Red Sea. So they still have to sail all the way around the south of Africa. It takes more time. They want to make sure they get goods in time for these peak consumer events. And the other issue is the cost of fuel. So for the spot market, carriers have introduced these emergency fuel surcharges right away, and they probably applied some of these surcharges to shippers with long-term contracts as well. But for the most part, for long-term contracts, fuel is paid in BAF adjustments, so bunker adjustment factors, and that's on a quarterly basis. So whatever happened in this quarter, rates are going to be adjusted the following quarter, and you're going to be paying for what happened in the previous quarter. So if fuel prices went up this quarter, in the following quarter, you're going to start paying for what the carriers are paying that quarter. And so that happens in July for contracted shippers. So there's some speculation that some of the early demand increase is shippers trying to kind of front load ahead of those higher fuel costs, which are going to happen in July. So we've seen rates increase, and we see carriers are announcing a lot of different rate increases for June, ranging from $600 per container up to above to $1,000 per container in the form of GRIs and peak season surcharges. So they're definitely going to try and continue to push rates up, and demand is probably going to continue to increase as well as we get deeper into peak season for these lanes.
Okay, and how about on the Trans-Pacific routes?
Yeah, so on the Trans-Pacific, we also saw mid-May GRIs stick, which we saw rates increase initially, and I wasn't totally confident they were going to stay, but we've seen them continue to increase. Rates have increased by 10% on both lanes last week. So it seems like peak season is starting early here as well. The BAF factor, right, the fuel costs on this quarterly basis might be a factor here as well. And the other speculation is that Amazon actually moved up Prime Day. So generally it's in July, and at the end of April is that they're moving it to June. So that might be a factor here as well, that, interesting that this one announcement can kind of change when volumes move. but that e-commerce sellers are bringing in inventory a little bit earlier than they normally do in order to be ready for that. So we see rates increases, and likewise, we see a lot of plans for additional rate increases as high as $2,000 per container, also for June 1st and into mid-June in the form of GRIs and peak season surcharges. So it looks like peak season is going to get underway here as well. We'll see how strong demand is, and we'll see how high rates will actually go.
Okay, interesting. Just back to fuel costs for another minute. So elevated prices have been even more disruptive to air cargo. There was more concern there that supply would actually run out. So what's the latest with air cargo trends?
Yeah, so about 6 weeks ago, the head of the International Energy Agency made a statement that regions like Europe were probably going to run out of fuel within 6 weeks. That was 6 weeks ago. And now we see that really there are major concerns about actual supply running out, though we know that rates for fuel are still elevated. And that statement was probably true if kind of the supply chain for jet fuel had stayed the way it was and had meant to, rely on the same sources it was relying on then. But we see this hasn't been the case for a couple reasons. One is kind of adjustment of where jet fuel is coming from, so increases of production in alternative places. But we've also seen a reduction in demand because a lot of carriers have been canceling borderline profitable and then unprofitable flights when the price of fuel went up. So for those two reasons, we've seen jet fuel prices go down. They're about 25% lower than they were at their peak, which was in March. And so we see some carriers reducing their fuel surcharges as well, and that's meant kind of lower rates and more sustainable supply chain for jet fuel in terms of not actually running out of supply, although again, rates are still much higher than they were before the start of the year. So these trends together in terms of jet fuel rates, as well as some continued capacity recovery, especially from the Middle East carriers, that's meant that we still have rates kind of well elevated from where they were before the war, but for the most part, they're past their peak, which will reach in mid-April to early May, depending on the lane. So Freightos air index rates for China, Europe eased a little bit last week, South Asia to Europe as well. Southeast Asia, Europe increased about 10% less, but they're still about 10% lower than their peak in May. China to North America, though, rates have been increasing the last couple weeks. There was a 12% increase last week, above $6 per kilo. And that might also be driven by the Prime Day factor. Prime Day is getting closer, so electronics importers or things like that, they might be increasing volumes right now as well. But there's still kind of been resilient demand. So in addition to e-commerce, also AI hardware is becoming more and more of a factor for air, which will sustain source of volumes as we move forward.
Okay, got it. All right. Thank you, Judah, for another interesting session. That's all we have time for. If you enjoyed this session, please hit the subscribe button and you'll get notified about all our future episodes. Thank you for listening and goodbye.
Bye.